we've seen is a lot of the strongest demand and a lot of the strongest growth, say like Boise, which is it's not a big market, but we've seen, Huntsville, we had like people moving from the coast to the secondary markets. And now there's the next wave of migration is from because some of the secondary markets have gotten almost as expensive as the primary market. So
Right.
that would be one other thing that I would recommend investors look into.
Hey, everybody, it's Samantha Parinello, the host of Wealth Unfiltered. Today is our second episode in the series on multifamily 2026 outlook. I'm very excited as I have an incredible guest for you all. We have the Director of Research and Publications from Yardi Systems, Inc. All right, everybody, I'd like to welcome to the show Paul Fiorilla. Welcome, Paul.
Thank you, Samantha. It's great to be here.
I am very excited to have you on our series. This series is all about educating people on what the 2026 multifamily outlook is being projected as. And of course, we're very interested in what Yardi has to say about this. So I would love first for our guest to understand who you are, how long you've been with Yardi, and what you do on a day-to-day basis.
I oversee national research, North American research for Yardi, which is one of the top data providers and top service providers in the multifamily industry. So I've been at Matrix now 11 years. I produce our outlooks, our monthly reports about multifamily market, in papers about industry trends and affordable, regular market rate multifamily, SFR, BTR. And, I represent Yardi within the industry, various trade groups. I've been in the commercial real estate industry for this is my 30th year. I covered the first 12 years, I covered CMBS and capital markets for a newsletter called Commercial Mortgage Alert. And then I was about 6 years at Prudential Real Estate Investors in research.
That's amazing. So as far as Yardi goes, or I should call it Matrix, I think is how you refer to it.
It's Yardi Matrix, yeah.
So what is it that you're looking at on a day-to-day basis?
So, we have a database of 120,000 multifamily properties with, 25 million units or so, and about 26,000 properties are fully affordable. So we get an enormous amount of data, and then, our customers use our data to underwrite transactions, to do market research, all sorts of different reasons. And, I'm always getting updates of, the monthly changes in, rents and expenses and absorption and, all sorts of different metrics that we cover. And then I look at those and try and decide, what the trends are. And I use that to, again, write our publications and, speak to industry groups and, formulate an outlook for the market.
So to say that you have, I would say probably one of the best up-to-date data exposure is probably pretty accurate.
I'd like to think so. If I say it, it'd be bragging, but you could say it, yeah.
Well, I love it because I think that just speaks to, when we dive into some of these questions, I think it's going to be able to really show that you have not only obviously the credibility in what you're doing, but then real-time information that's going to be the most up-to-date. So that being said, I have an opinion question for you. Based off of what you've been seeing, how would you characterize the 2026 real estate market?
Well, if you're talking about multifamily, I'd say that multifamily is in a bit of a slog right now, right? So we are forecasting slow rent growth. Capital markets have issues. And, it kind of goes back a few years. So coming out of the pandemic, we had a tremendous amount of rent growth. There was record amounts of demand and absorption for multifamily. Rents shot up 24% over 2 years, and 21 and 22 combined. And then since then, rent growth nationally has flattened, but there's been big regional differences, right? So the Northeast and the Midwest has seen consistent They didn't see, like, the huge increases. They saw big increases during 21 and 22, not quite as much as some of the other Sunbelt markets, but they've been consistent. New York, Chicago, San Francisco set aside, Northern New Jersey, Boston, a lot of these markets have been Columbus and Indianapolis, Kansas City, they've had, like, 3, 4% rent growth pretty consistently the last few years. The the high growth Sunbelt markets have seen rent growth either flat or negative over the last few years, and that's been a result of, because developers were kind of following the growth story, we saw a huge amount of record, at least multi-decade record high supply growth. So there were so many deliveries that it just created excess supply. So in, like, take Austin, for example, they've added 25% to their multifamily stock over the last 3 years. Rents are down about asking rents are down about 15% over the last 3 years cumulatively. So, and that's the most extreme example, but that's the trajectory that's been happening in a lot of these Sunbelt markets. So, where we are now is we have slow growth. Last year, multifamily rents were essentially flat. They were up about 1% the 2 years before that. And this year, we're forecasting, again, less than 1% growth nationally. But again, that regional disparity still exists. So in the Sun Belt, how long will it take markets, Austin, Nashville, Phoenix, Denver? Denver's Mountain West, but it's kind of in that category of fast growth markets. So they've got a lot of supply where, that are properties that are in lease up, and it's kind of keeping flat or less than the demand, although demand remains strong, but it's just not enough to fill all those units. So as a result, you've seen a lot of concessions, you've seen a lot of operators in those markets having to do things to allure people to keep occupancy up. So I think it's gonna be continued slow growth, maybe even some negative numbers in those markets again in '26, and we'll see, I'd say for at least a year, year and a half that there's gonna be slow rent growth nationally.
Do you think, based off of everything that you're looking at in the data, when you think about the end of 2026, early 2027, that many of those markets are gonna have corrected a little bit? Or do you really think that it's still gonna be more of a blanket across the Sun Belt, across some of these growth markets, that there's still gonna be stagnation and or not any growth?
That depends a lot on what happens with the economy and demand. If demand continued at the levels we've had the last few years, where we've had extremely strong demand and starting in 21 and especially 21 and 20, the first half of 25, then I'd say that excess stock will get absorbed, in the next few quarters. But that's a big if, because I mean, what we're seeing now is our data showing absorption slowed a lot in the second half of the year. And now absorption always slows a lot in the fourth quarter, but it slowed a lot more than usual, kind of the typical, I guess it's typically, if I look back and at the numbers, typically there's about 30% fewer units absorbed in the second half than the first half. But this year was closer to like 80%.
Oh, wow.
Is that a temporary thing? It depends on demand. So when I look at where demand is going, there's several things that kind of determine how strong, demand is and absorption is for multifamily. Now, on the positive side, I'd say that, the home sale market, that it continues to be weak, that prices are really high. That's continuing to keep tenants in apartments. So all the big multifamily owners will say, they have fewer people moving out to buy homes than they used to. People are renting longer, wealthier people are renting, more than they did a generation ago or even, 15, 20 years ago. So that's a positive for demand. On the other end, we have, I mean, we see what's going on in the news, right? Immigration. In fact, we just saw the numbers, right? Immigration, we had a couple of years when demand was strong. We had a lot of immigration. We had a couple of years with 3 million new immigrants coming into the country. And, whatever you think about that, it's a political issue. It puts bodies in, in housing. So we went from, according to the Census Bureau, we went from like 2.7 million population in growth in 23, 24 to 1.3 million 24, 25.
Wow.
And, based on what we're seeing, again, immigration policy is not favorable for toward keeping, bringing people into the country, and other people are being removed from the country. So immigration, which was a source of some of that strong demand, is drying up.
Right.
Um, the job growth, which is another factor, we had, a few years where we added, 2, 3 million jobs per year. And last year we had 180,000. And that's not directly related to population, but when people have more income, they'll form their own households. And, I my own kids are an example of this. So, my oldest two sons, when they graduated college, they got jobs in New York City. I live in northern New Jersey. They got jobs in New York City and, were commuting for a while and then decided that kind of wasn't what they wanted to do. So they moved into the city. And, their first apartments were, they were in like roommate situations, kind of squalid, but that's another. And but, as their employment situation proved, as they, got better jobs, then they were able to go out and form their own households and, live in their own apartments. So that, that's not an increase in population, but it creates demand, when the economy is good, when people's job situation. So the combination of fewer jobs and the fact that you have young people finding it hard to find their first jobs, that's kind of the prime renter age, people getting out of college, getting jobs and, leaving their parents and whatever. So if we see less of that, that's another, kind of drag on demand. So, if if the, things rebound to a more normal state, with the economy, with immigration, then demand will then this absorption process will be quicker.
Right.
If not, it'll take longer. So, I put it anywhere or, between a year, 2 years before we start to turn that around. The other thing is supply, right? So that's demand. And, we're forecasting 450,000 multifamily units per year over the next few years. That's kind of now starts have dropped pretty considerably from about 40% from the peak in like 23, early 24. But it's because of, there's already, 600,000 units under construction. They're going to get built and starts haven't completely dried up. So when we look at market rate multifamily, partially affordable, fully affordable, SFR, BTR, senior housing, and student housing, we're forecasting in the area of 450,000 multifamily deliveries over each year over the next few years. So supply is not going down as much as other people, some people hope. And
That's
the
right.
last
When you
fact,
talk about supply, do you think that this year then we'll find it finally like vacancy peaking and then it kind of because of the supply?
yeah, vacancy is not a huge problem I mean, nationally, the vacancy rate of stabilized properties is almost 95%, and we don't see that changing a lot.
Perfect.
There are in our data, though, does not count properties in lease up, and that's kind of where the problem is, right? So that the number of properties in lease up, which was like really high, no, and when I say lease up, I mean, after a multifamily property is newly delivered,
Mhm.
it's a few quarters before it gets stable, where they are able to get up to, 70, 80% occupancy and 90% occupancy or whatever. And so that number was close to, I don't know, 800,000 or something a year ago. It's come down a bit, but there's still somewhere between 500, 600,000 multifamily properties national, kind of in that lease-up stage. And the other thing about that, though, is, like, I'm talking about a national number.
Right.
I don't have time to talk about every market, but what really is important for supply growth and, talking about things like lease-up is, kind of the market level. So where that is important at this point in time is in those high growth Sunbelt markets that have a glut, right? So the national number, New York doesn't have a glut of properties in lease up. Chicago's, Chicago, San Francisco, there's a lot of markets that have not had enough development and they still don't. And those markets are seeing supply growth drop just as fast as the high supply markets. But when you look at and if I can share my screen a second. So here's our forecast over the next 5 years for supply growth, and it's come down. There's a lot of markets. Some of the markets like Austin and Nashville and Charlotte have seen like 6, 7% supply growth some years in recent years, and that's going down. So this is a 5-year supply forecast, through 2030. And, Dallas has the most, but as a percentage of stock, it's 2.6%. That's high, but probably manageable considering how, Dallas grows. But some of these other markets, Phoenix, Austin, you know, have Charlotte have, 4% plus supply growth per year. So when you look at it in that sense, then, you know, it's it'll take time to absorb all those units, and they're still, it's not like supply is going from 6% to 2%. It's still gonna be 4% in some of these markets. So that will also kinda slow the absorption to bring those prop markets back into a spot where they could start raising rents at kind of a normal level again.
And these numbers are that are on this slide are also talking about the numbers you had mentioned before with the 6 to 800,000 that were still coming online already, correct?
The 6 to 800,000 was properties in lease-up, I think, but this is just like metro by metro forecast for the amount of new supply. These are, I guess, about 30 major markets,
I see.
um, and that's what we expect to be delivered between now and 2030.
Amazing, yeah. I've heard a lot about the growth going on in Kansas City. I was just looking at your chart and it's showing like 2.3 or 2.4, but
Yeah.
I've heard that that's actually a pretty hot market right now as far as growth is going for multifamily.
Yeah, Kansas City has been a strong market and, 2.4% or 2.3%, I guess is the number. That's a lot for Kansas City, right? So that's, the long-term average is, right about 2% for supply growth, big picture. So when you get, you know, oops, when you get, Kansas City's not traditionally been most of the Midwest, most of the Northeast have not traditionally had a very strong supply growth for various reasons. So that's a pretty good number. Now, northern New Jersey is another one where, the long-term growth forecast is like 3% per year.
Right.
And, New Jersey, which has been a very strong market in recent years as far as rent growth and absorption and the economy. It's not people don't think of it as, kind of a high growth market, but it's been pretty strong. There's been a lot of development spurred by the state regulation, the state requirement that towns build affordable housing. So that's been kind of a positive in that market.
Well, and one thing that, investors think about when they are considering investment in a market, whether, they're not necessarily looking at new deliveries because that's not maybe, and they're not interested in new development. But I think one of the aspects of when they're looking over a market and deciding whether or not they want to invest there, they're looking at the asset class as well, right? So it's in your research that you're looking at, are you seeing where the vacancy rates or the absorption that's happening across like the spectrum, are you seeing that people are kind of going more towards the class A units and those are filling faster, or is it more of the affordable housing is staying more positive? Like, where are you seeing those trends happening?
Well, there's a couple of things I would say about this. One is that almost all, like, about 90% of new construction is luxury, what we would call lifestyle properties. And when we go back to there's certainly, because of we're talking about the economy and affordability, a growing number of rents res re tenants are, rent burden, which means they pay more than 30% of their income on rent. So that those numbers keep going up. So there's definitely demand on the lower end of the spectrum. But when we look at, again, big picture numbers, coming out of the pandemic, the lifestyle rents grew a lot faster than renter by necessity, kind of like what we call B, C kind of class units. So the higher end units, rents grew faster. There was a lot of demand. A couple of years ago, that kind of flipped, and the renter by necessity segment is growing slightly faster. And the occupancy rates of high end properties are pretty similar to the renter by necessity units. I think what I said before about higher income people renting more and longer and to higher ages has been, a positive factor for lifestyle. And then on the other end, there is definitely, because people are struggling economically at the bottom, 40% or so of the income distribution, that creates demand for, middle market type units. We we have we did a study which is kind of interesting that has gotten a lot of attention in the affordable world, where we compared rents of market rate properties to affordable properties. So we track affordable properties, the maximum allowable rent that based on, so when I say affordable, I mean capital A affordable. Let's just be clear here. That means, that the property has, like, at least 90% of the units are exchanged. They limit rents in exchange for a subsidy, right? So
Mm.
limit rents to a percentage of AMI, whatever, it might be 60 or 80% or 40% or whatever the number is that's in the particular agreement that that property has. So, like, those are capital A affordable properties, and they use, like, LATEC, the low income housing tax credits, or that's the biggest one, but there's literally hundreds of subsidy programs that exist on the federal, state, and local levels. And when we compared by metro, what percentage of properties in that metro are competitive with market rate, or the competitive what percentage of market rate properties are competitive with affordable, in some markets, the and the methodology would take a while. If you're interested, you can write me or look up the paper for all the methodological details. But basically, if the market rate properties are within 10-15% of the rent that affordable properties can charge, we would consider that to be competitive. So in some markets, more than half of the market rate properties are in that competitive range with affordable properties. In some markets, there's very little competition, and why that is has to do with, the absolute amount of rent in the market. So if, like in New York or San Francisco, the average market rate rent is, $5,000. Affordable rents aren't anywhere near that on average. So, the level of competition is less. Another factor would be, like, when the stock was built. So some markets like Baltimore or St. Louis, most of their multifamily stock was built, 40, 50 years ago. And as a result, they're what we would call, like, naturally occurring affordable rents. So they're like class, B minus C kind of properties that are affordable. But if markets where there's more competition, then it becomes harder for affordable property owners to attract and retain tenants. Because if you're a tenant and you can get a market rate property for, $100 a month more, $200 more, you might say, I'll have to go through all the application process. That property probably has nicer amenities, whatever. So, there's some markets where, again, like the occupancy rate of affordable properties, like 96, 97, 98%. And then there's others where it's in the low 90s or in the case of like Austin or Dallas, even less than 90, just because there's so many options at the moment right now for, if you're a tenant looking at a low income property or, a property that has more affordable rent.
That makes sense. When you look at, we were talking earlier a little bit about sustainable rent growth, like what you're going to see over time. If you look specifically to 2026, do you think, when you're looking at nationally, that 2 to 3% is going to be the average?
Well, our national forecast for 2026 is 0.5%. So
Oh, wow.
I think 2 to 3% will be some of the, that would be like the high end of rent growth this year. And that's again at places like New York, San Francisco might be a little bit more than that because San Francisco is kind of like a unique market in that, rents did not go up after the pandemic, because there was a lot of migration away from San Francisco and the city had kind of some issues during that time. But it has just recently, over the last year or so, started to recover. So San Francisco is going to be one of the stronger markets this year for rent growth. Chicago, which has very, it's, again, Chicago, the downtown office market has a lot of problems. There are parts of Chicago, that have issues, but, on the whole, especially suburban Chicago, there's been almost no supply added and demand is not great and it's not, as strong as, some of the Sunbelt markets, but it has decent demand. As a result, rents are consistently gone up.
Right.
You have other markets like Kansas City, Indianapolis, Columbus that are, just growing markets. And they also have had sort of moderate levels of supply growth. So I would expect those markets to go up to 3% this year.
Okay.
But, generally speaking, I think, on a national level, 2 to 3% would be kind of the high end and other markets are still going to be, there's, half the markets in the country right now, rent growth is negative year over year. And, we'll probably see better numbers in 2026, but I don't think we're going to see that kind of growth. And then, the other thing is, when we look at rent growth, over a 5-year period since 21, again, rents are up almost 25% over 5 years. The long-term average for rent growth and is about 2.6, 2.7%, before that COVID spike.
Yeah.
And since 21, the rent growth has gone up 4.3% on average per year nationally. So even if rent growth stays weak, we're still, over a longer period, the rent growth is relatively high compared to historical norms. And I think part of the reason that rent growth is slow is, kind of affordability got strained and
Yeah.
the market kind of got ahead of itself. So I think that's another factor for, weaker rent growth this year.
Well, another factor people obviously look at is, cap rates, cap rate compression, understanding how that's going to affect them. So when you guys look at the total today's cost of capital, where are you seeing cap rates? Are you guys projecting that they're going to come down this year?
Well, we don't I'm not projecting cap rates, but, we've had this situation, again, going back to, a few years ago where we had a long period of low interest rates and mortgage rates, which is, the cost of capital, were super low. So you go back to like 20 and 21, early 22, mortgage rates for multifamily were, 3, 4%. And that enabled buyers to bid really low cap rates. Then in 22, you had rates go up, the short-term rates went up about 475 basis points, I think, over a very short period of time. And that created kind of a lot of issues. So properties that had short-term loans that had taken out floating rate 5-year, 3 to 5-year loans just before rates went up. Suddenly their loans are all underwater. I did a calculation a few years ago where, if you had a $10 million mortgage and you had a 3% interest rate, and then you had to refinance that with rates at 6%, and you were keeping your monthly payments the same, well, your property would only qualify for, like 7.9 million or something like that,
Right.
of debt. So you have that suddenly a lot of these properties had, a gap to fill. And that's why we have kind of that, you know, long, slow period of, extensions going on. But at the same time, cap rates, acquisition yields, whatever you call them, they're dependent on the cost of capital. So, you know, 4.5% cap rate made sense when mortgage rates are 3%. When mortgage rates, now at 5-6%, that, 5% cap property is, the premium over your, the mortgage rate is not much, right?
Yeah.
So I think it's going to be really hard. And so prices, kind of peaked in 21 and went down 20-25%, again, big picture nationally. And they've kind of bounced around. They've gone up a little bit and since then, but pretty much the same. So, but that created, this huge bid ask gap
Mhm.
between buyers and sellers, because sellers are like, well, I want, the deal that I could have gotten a few years ago. My property's still performing well. Why should I take a discount? And buyers are like, well, if I pay that, then I've got, I'm basically paying, with no spread over, the treasury rate, that doesn't make any sense. So deals that are getting done are, either like really stable properties
Mhm.
or, kind of more value add on the other end of the spectrum, more value add where, the seller kind of, it absolutely has to sell. The biggest problem right over the last couple of years for the transactions market is that, there's plenty of capital willing to buy. There's plenty of lenders. I mean, there's all the lender, CMBS is active, the debt funds are out there, banks want to lend again, insurance companies are active. There's plenty of debt there available, but, sellers are, kind of holding on. And then you also have cases where, the mortgage is underwater, but there's cash flowing. So, and again, banks, don't want to just allow borrowers to extend without paying, either paying down the principal or, adding in some reserves or doing something.
Right.
And but if the borrowers are resisting, so I think, there were a lot of people a few years ago are predicting like another GFC situation
Right.
where, all these loans were going to go bad at the same time. And having been in the CMBS market in 2007 when everything blew up, 2008 when everything blew up, I didn't think that the market a few years ago was anywhere near that aggressive, or I didn't think that the situation was the same.
Mhm.
But, so we've had this kind of like slow unwind, and I expect continue to slowly unwind. There's no like absolute pressure on anyone in a lot of cases to resolve it. And until, I mean, if something could trigger a lot of these things coming undone, but otherwise I see, a slow unwind of these bad deals, of these underwater loans. And I also think that, cap rates are, I don't see much change, right? Because
Mhm.
there's a lot of capital, but you also don't want to, you don't want to buy properties, at like say 4.5%, cap rate, you know, when, the cost of capital is kind of in that area. Now, deals that are getting done are deals that, somebody's like, well, I'm expecting to increase cash flow, or I'm going to hold it for 10 years and I think I'll be fine. But I
So I
think
have
we're going to
another
keep,
question for you.
yeah, go
You
ahead.
guys have obviously you were saying like you have a pretty wide database because you have tons of apartments within your database. But do you guys ever like go out to either investors or to the capital markets and do any types of surveys where you could give us information on if people are they activated again and really expecting to deploy?
Well, we track transactions. We don't do those kind of surveys,
Okay.
but again, I mean, I'm active in a lot of, the trade groups. I'm, out in the market talking to people. So, my expectation is that, transaction activity will improve a little bit this year, but, I still think it's going to be a slow unwind and, fixing the problems that were created, in 2022.
Right. When you okay, so I know that I've taken up a lot of your time, so I just want to ask a couple more questions if that's okay.
Okay.
Okay. So what I wanted to ask you was when you look at the change of the next 12 months and you're looking at what we're going to, you guys are forecasting for all the different variables for multifamily. Are there two that are distinct that you think like investors should be watching for?
I'm sorry, to
Two variables that you guys are like actively watching over time that you think will make the most be the most impactful changes over 2026?
yeah, I personally think, that absorption and demand. Now, absorption isn't exactly demand, but it's the closest thing we can to measure it. I think that that's going to be something to watch. I mean, I've been watching it over the last year, and I think that's going to be very important because if demand rebounds to like early 2025 levels, then that'll correct a lot of other problems, but if it doesn't, then, that just kind of indicates the slog before we, get back to normal it'll take longer. And what would be another one? I guess I would look at, again, kind of transaction volume, and that would be a indicator of how that kind of dynamic between buyers and sellers, if we start to see transaction value pick up, I think that would be a sign that investors are optimistic because, again, to do a deal these days, you really have to be, if you're going to buy a property for even, 5.5% cap rate, you have to be pretty optimistic that you're going to see an increase in cash flow. So, I think that's another thing that I'm gonna, be watching this year.
Okay. And my last question for you is based off of all of your research that you guys have done, what market, so regional or specific city, do you think overall investors are most bullish on this year so far, or which they should be?
Again, funny, San Francisco, is probably bullish for this year because of the recovery. I think all the attention on AI has and back to work has got a lot of people, you know, moving back into San Francisco, and because the rent growth there was so weak for so long, you're starting to see a pickup there.
Does San Francisco mean like all of that top Bay area, or is that specific to like the city of San Fran?
Yeah, it's the Bay, it's San Francisco and,
Like
I guess
Oakland and all the
yeah,
adjacent.
Oakland, not as far as San Jose. That's a different market for us, but yeah, I mean, San Francisco and the immediate, suburbs around the city, not just the city proper, which is, relatively small. But
Okay.
yeah, that's a really strong market. Some of the Midwest markets are look to be pretty strong this year. Again, like Chicago, Columbus, that have kind of consistent kind of rent growth over the last few years, and we expect that to continue. One other thing I would say about that would be there's a lot of like tertiary markets. So one of the things that we've seen is a lot of the strongest demand and a lot of the strongest growth. Say like Boise, which is it's not a big market, but we've seen Huntsville, some of these markets that are, I guess you'd call them like satellites to bigger markets
Right.
where there's an extreme amount of demand over the last couple of years. They've been like the highest amount of growth markets, and some of the markets, it might be around places where there's like new chip factories being built or new manufacturing facilities that will add to job growth. But that's another trend where, like over a few years ago, we had like, people moving from the coast to the secondary markets. And now there's the next wave of migration is from, secondary markets out, because some of the secondary markets have gotten, almost as expensive as the primary market. So
Right.
that would be one other thing that I would recommend, investors look into if, they want to invest in smaller markets, if they can do that.
Awesome. Well, thank you so much, Paul. I really, really appreciate your time today.
Thank you. It's a pleasure to be here.
Wonderful. And thank you to all of our listeners. Stay tuned for the rest of our series.